Fixed assets and depreciation. Understanding the difference between repairs and routine maintenance versus improving an asset is necessary for all accountants. Repairs and routine maintenance will be expenditures such as oil changes, painting a building, repairing a broken windshield, and these are referred to as revenue expenditures. Improving an asset would extend the useful life or add value to the asset, referred to as a capital expenditure. Adding a wing to a building, hydraulic lift to a truck that did not already have one, adding fixtures to your store that are permanently attached would be considered an improvement. There are two main reasons why fixed assets are depreciated. Functional depreciation is the result of an asset becoming obsolete or the asset no longer serves the purpose to meet customer requirements. Physical depreciation is normal wear and tear from the use of the asset through normal operations. When depreciating an asset, there are a few tidbits of information needed. First, we need to know the cost of the asset. Second, we need to know the estimated useful life. And third, we need to know the estimated salvage/residual value. The basic formula for calculating depreciation is cost minus residual value divided by the useful life equals the depreciation value. This calculation can be computed as monthly, quarterly, or annual figures. Straight line depreciation. Susie Q bought a building to be used for her firm, and the cost of the building is $700,000. The expected useful life of the building is 20 years, and the residual value is $100,000. Let's compute the depreciation based on the straight line method for annual, quarterly, and monthly values. To determine the annual depreciation, we will take the $700,000 minus the $100,000 residual value, and we will divide by 20 years. And this gives us an annual depreciation of $30,000. To determine the quarterly depreciation value, we will take the $700,000 cost minus the residual value, and we will divide by 80. And this gives us $7,500 of quarterly depreciation. Please note that there are 80 quarters in 20 years. Monthly depreciation, $700,000 cost minus the residual value divided by 240. And this equals $2,500 per month. There are 240 months in 20 years. Double declining balance depreciation. Before beginning the double declining calculations, you need to know the following: the rate of depreciation based on the straight line method, and then multiply the rate by 2. This method is considered to be an accelerated method of depreciation. It will result in a higher depreciation expense in the first year and lowers each year after that. Companies will tend to stay away from this method due to the effect on the financial statements. The first year of placing the item in use could result in lower net income. Let's take a look at an example of double declining depreciation. Susie Q bought a truck to be used for her firm. The cost of the truck is $50,000. The expected useful life of the truck is 5 years, and the residual value is $4,000. Let's compute the depreciation. The straight line annual amount of depreciation is $9,200, and the rate at which the asset is depreciated is 0.20 or 20%. And we're going to multiply the 20% by 2, and the double declining depreciation rate is now 40%. Here's a chart. In the first year, we start off with a $50,000 cost. The book value is $50,000. We will multiply that by the 40% double declining balance rate. The depreciation for the year is $20,000. The book value at the end of the year is $30,000. On the second year, we've accumulated $20,000 of depreciation. The book value is $30,000. We're going to multiply the book value by the 40% double declining balance rate. And the second year depreciation is $12,000. And now the book value is $18,000. In the third year, we now have accumulated depreciation of $32,000. The book value is $18,000. We multiply by 40%, and the third year depreciation is $7,200. And at the end of the third year, the book value is $10,800. In the fourth year, we've accumulated depreciation of $39,200. The book value is $10,800. We multiply by the 40%, and the fourth year annual depreciation is $4,300. At the end of the fourth year, the book value for the truck is $6,480. Entering into the fifth year, we have accumulated depreciation of $43,520, book value of $6,480. We multiply the book value by the 40% double declining balance rate to determine that the fifth year depreciation for the year is $2,592, ending with a book value of $3,888. However, we had a residual value of $4,000. So in the fifth year, we must do an adjustment to make sure that we do not depreciate more than the residual value. So instead of the $2,592 in depreciation, we're actually only going to have $2,480 of depreciation in the fifth year, so that the book value now will be $4,000, and that equals our residual value. Only in the last year of the double declining balance depreciation will you have to possibly do an adjustment. Units of production depreciation. This method of depreciation is based on the output of the asset. For example, a small copier will yield 100,000 copies in a lifetime. The copier was purchased for $3,000, and the residual value is $200. In year one, the copier produced 30,000 copies. In year two, 25,000 copies. Year three, 32,000 copies. And in year four, 13,000 copies were produced. The cost of the copier is $30,000. The expected output is 100,000 copies, and the residual value is $200. To determine how much we will depreciate per copy, we will take the cost minus the residual value and divide by 100,000. This equals 0.028 per copy. So in year one, we produced 30,000 copies for a total annual depreciation of $840. In year two, 25,000 copies, resulting in $700 of annual depreciation. In year three, 32,000 copies with an annual depreciation of $896. And in year four, 13,000 copies resulted in $364 of depreciation for the year.